Today, let the games begin! Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. Well, the battles between central banks and their bond buying programs and the markets is continuing apace. And I think we are beginning to see some interesting developments which suggests to me that the shenanigans is only just starting. To start with, let's just quickly review the movements on the markets today and then try and get behind some of the commentary to try and figure out what's going on. It's pretty important, of course, because this fundamentally leads to the question about, is the future inflation or deflation led? And will the capital markets and the hedge funds win over the central banks, or will the central banks win out? And there is the old faithful saying, of course, never bet against the Fed, because of course they have unlimited resources and in theory can go on buying bonds and creating financial flows from absolutely nowhere forever. But of course things may not be quite that straightforward. Anyway, let's start by looking at the local markets and then the international markets over the last 24 hours. The ASX 200 in Sydney closed down 2.35% to 6,673. The financials index was down 2.21% to 5,809. The real estate trusts were down 1.71% to 1,339. And the volatility index rose dramatically up 23.86% to 17.63. The S&P ASX 200 futures is down 0.74% to 6,659, signalling more falls ahead. Amongst the banks, ANZ was down 2.24% to 26.17. CBA was down 2.56% to 81.56. NAB was down 2.03% to 24.64. And Westpac was down 2.22% to 23.82. Amongst the regionals, Bank of Queensland, of course, announcing their acquisition of ME Bank, was down 1.9% to 8.79. Bendigo was down 3.27% to 9.77. Suncorp was down 3.12% to 9.94. And Macquarie Group was down 1.95% to 142.48. AMP was up 7.53% to $1.50 on some better news, although I'm still not totally convinced, frankly. Lenders Mortgage Insurer Genworth was down 3.73% to $2.58. And McGrath Real Estate Agents were down 3.08% to 63 cents. AFG, the mortgage aggregator, was down 2.09% despite reasonable results to 281, and the mortgage choice was down 1.68% to 117. Afterpay was down 11.04% to 119.52, having announced, of course, their intent to reach out to the US, and reported another loss just the other day. And CIMEC, the building and construction group, was down 1.98% to 21.29. Looking at the currencies, the Aussie dollar was down 0.46% to 78.35, having peaked at 80 cents quite recently. And the euro Aussie dollar was up 0.28% to 1.55. Looking at bonds, well, you can see there the movements are all over the place. The 2-year bond was down 3.78% to 0.115. And the 10-year was down 0.76% to 1.838. The reason for that is that the Reserve Bank bought into the yield curve quite significantly over the last couple of days to try and pull the rates down. Gold Aussie Cross was up 0.05% to 2,247. And the Bitcoin Aussie Cross was down 8.63% to 58,191, so significantly off recent highs. Now, over in the US last night, the Dow Jones was down 1.75% to 31,400. The S&P 100 was down 2.5% to 1,739. The S&P 500 was down 2.45% to 3,829. And the S&P 500 Financials was down 1.81% to 546.42. Goldman Sachs amongst the banks was down 0.87% to 327.76. And the overall volatility index was down 1.38% to 28.49. But of course, that's still quite a bit higher than recently. The Nasdaq was down 3.52% to 13,119, and there were significant falls for some of the major stocks like Google, Alphabet down 3.26% to 2,015, Amazon down 3.24% to 3,057, Apple down 3.4% to 120.99, and Facebook down 1.64% to 254.69. Turning to the bonds, the 30-year US bond is up 1.34% to 227. And you can see there the very consistent rise over recent times and the acceleration of rate. That is what is spooking many people, signalling higher inflation possibly ahead. Now, the 10-year was down 1.82% to 1.487, but still a lot higher than recently. And the 3-month was sitting around 0.051, up 17.91% on the day. The dollar index was up 0.31% to 90.41. And over in the UK, the FTSE was down 0.62% to 6,613. Gold was down 0.96% to 1,758. And silver was down 2.56% to 26.93. And among cryptos, Ethereum was down 12.15% to 1,436. Bitcoin was down 10.48% to 45,171, considerably off recent highs. And while we're looking at various stocks, just quickly, the old GameSpot stock was all over the place, up 18.56% to 108.73, as some investors are trying again to see whether they can move the market on it. But of course, the real question is, well, what is really going on here? Certainly, Asian stocks skidded to 1-month lows at the start of Friday, following that rout on the global bonds markets, because yields started rising, and that spooked investors and caused fears that heavy losses could be triggered if distress selling of other assets came across. The scale of the sell-off prompted Australia's central bank, the RBA, to launch a surprise bond buying operation to try and staunch the bleeding, helping yields there to come off early peaks, and they did it all again today, during Friday, but wasn't totally successful. The fixed income route is shifting into a more lethal phase for risky assets, said Damien McClough, Westpac's head of rates strategy. The rise in yields has long been mostly seen as a story of improving growth expectations, if anything, padding risky assets. But the overnight move notably included a steep lift in real rates, and that brings forward the Fed's lift of rates. Marks were hedging the risk of an earlier rate hike from the Federal Reserve, even though officials this week vowed any move was long into the future and more stimulus was required. In fact, Fed fund futures now almost fully prices in a rise to 0.25% by January 2023, while the euro dollars have discounted it for June 2022. Even the thought of an eventual end to super cheap money sent shivers through global stock markets, which have been regularly hitting record highs and stretching valuations. MSCI's broadcast index of Asia-Pacific shares outside Japan slid 2.4% to a one-month low, while Japan's Nikkei shed 2.5%. And Chinese blue chips also joined the retreat with a drop of 2.5%. Overnight, the Dow had shed 1.75%, while the S&P 500 lost 2.45% and the Nasdaq 3.52%. That's the biggest decline in almost 4 months for the tech-heavy index. And of course, many of the tech darlings from Apple to Tesla to Microsoft all drag the market lower. All of that has elevated the importance of US personal consumption data, which is due out later today, Friday, which includes one of the Fed's favourite inflation measures. Core inflation is actually expected to dip to 1.4% in January, which could help calm markets, but any upside surprise would likely accelerate the bond rout. The surge in Treasury yields has also caused ructions in emerging markets, which feared the better returns on offer in the United States might attract funds away. And currencies favoured for leverage carry trades all suffered, including the Brazil real, the Turkish lira, and the South African rand. The flows helped nudge the US dollar index up more broadly, with the dollar index rising to 90.36. It also gained on the low-yielding yen, briefly reaching the high since September at 106.42, and the euro eased just a touch to $1.2152. The jump in yields has tarnished gold, which offers no fixed return, and dragged it down to 1,767. However, analysts at NZ actually are still more bullish on the outlook. We now expect US inflation to hit 2.5% this year, they said in the note. Combined with further depreciation of the US dollar, we see gold's fair value at around $2,000 an ounce in the second half of the year, or not. Oil prices held near 30 months highs, with profit-taking limited by a sharp drop in US crude oil output due to the winter storms in Texas, and US crude fell 44 cents to 63.03 a barrel. Now, John Authors, commenting on all these moves, said something big just happened in world markets. The bond market has been at the centre of the drama. Yields are rising, especially in the often overlooked belly of the curve, between the closely observed 2-year and 10-year maturities. An unsuccessful auction of 7-year treasuries certainly didn't help, but the trend through the day was pretty awful. Beyond the belly, however, which saw most action on Thursday, there has been a move away from duration, the technical term for bonds whose returns are most sensitive to changes in interest rates. Austria's century bond, issued in 2017 and not to be repaid in principal until 2117, is widely taken as the ultimate benchmark for duration, and this is what happened to that price. While treasuries, the world's biggest bond market, understandably command the most attention, this isn't just an American event. Before the market opened on Monday, Christine Lagarde of the European Central Bank stated that the bank was monitoring longer bond yields, causing them to fall sharply. That reversal, though, didn't last long. German bond yields are now higher than they were before she intervened, although they still remain negative. It's therefore a little bit hard to say exactly what they mean by being too high. Serious moves are afoot then, but it's worth pointing out that there has been big falls in bond prices before during the post-crisis era. This is a significant move for the bond market. It needn't in its own right be anything unprecedented or game-changing. And bond volatility is also back. Following the brief but terrifying financial crisis that accompanied the onset of the pandemic in March last year, central banks succeeded in effectively anaesthetising the bond market, while measures of stock market volatility remained elevated. This shows up clearly in the spread of the Kobe VIX index of stock volatility over the MOVE index of bond volatility. It isn't evident that central banks need to be too uncomfortable with yields at current levels, which still remain low. But the successing quashing seemingly all activity in the bond market seems to be over. Now, the question is, does this matter? Well, there are a number of reasons why it might. First, the bond market is central to setting interest rates for America's mortgages. In proportionate terms, the shock to the Fannie Mae 30-year mortgage, generally used as a benchmark for US home loans, was truly historic. Outside of one day during the worst of the 2008 crisis and 2 days during the COVID shock last spring, it was the biggest percentage rise in mortgage rates on record. To be clear, the sharp proportionate increase is enabled by the current low rates. Although these have been the norm for a while, the rise could still endanger the US housing recovery, a critical reason for optimism about the economy if it continues. Higher US rates are generally held to be bad news for emerging markets as they attract flows away from the sector and also tend to strengthen the dollar. That in turn could weaken emerging markets, and that is particularly relevant on dollar-denominated debt. Emerging market currencies have been enjoying a resurgence of late until Thursday, when rising yields in the US triggered their worst fall since March last year, according to JP Morgan Chase. Last, and deliberately so, we come to stocks. As a whole, taking all the global stock market into account, this isn't that much to see yet. The MSCI's index of global stocks, excluding the US, actually rose slightly on Thursday. Even tech stocks, which are under undoubted pressure, are still up for 2021 so far after a great 2020. Of all the main asset classes, stocks are actually the least scathed thus far. They've still commanded plenty of attention. That is because they matter most to politicians, and the Fed is, in perception at least, ultimately dedicated to making sure they don't suffer a big fall. As far as equities are concerned, they are the golden child. It's really the only market the authorities care about. It pains me to admit, but they must be your first priority. The critical question is, what point bond yields become too high for stocks to bear and cause them to fall? The mantra for the last year, as equities have enjoyed their remarkable post-COVID rally, is that stocks remain cheap compared to bonds. This is true, but the people excitedly buying stocks on this basis might be forgetting that the situation can also be corrected by a fall in bonds, and not just by a rise in equities. The rise in stocks has run out of steam for now, but compared to long bonds proxied by the relative performance of the popular SPY or TLT exchange-traded funds, their outperformance has now exceeded 100% since March last year. Beating on stocks to beat bonds has been a good and well-supported bet. It doesn't mean we can be guaranteed a stonking equity bull market into the middle distance. It might instead mean watching stocks follow bonds into a vicious bear market. That is the risk of over-reliance on equities' cheapness compared to bonds when choosing to buy them despite their extreme high valuations compared to their own fundamentals. The risk, to be clear, hasn't transpired as yet. It might never, which brings us to the need to explain why all this is happening. The great concern is the impact that further rises in bond yields could have on other asset classes, especially US equities and emerging markets. There is one great example of a bond market tantrum which followed comments by then Fed Chairman Ben Bernanke about tapering bond purchases in May 2013. The effect on real yields, unprecedentedly negative at the time, was immediate. The following graph compares 10-year real yields in that incident with 10-year real yields over the last 6 months. The pattern is obviously very similar to the pattern in May 2013, but we have far farther to go to match the tantrum of 8 years ago. What would cause that tantrum to go further? Plainly, the market is discounting a lot of reflation ahead, given the strength of the economic recovery that has already been priced in by stocks. All else equal, we would expect bond yields to go up and bond prices to fall as the expansion to back up those high equity valuations comes to pass. The reason yields aren't much higher already is that the markets assume central banks will act to keep them under control. Lagarde, Jerome Powell, and the battalion of other central bank governors have all made that clear over the past week. For the remainder of this year, and with the markets left to its own devices, the trajectory of bond yields depends, above all, on the course of the pandemic and the vaccination program to combat it. But for now, the issue, to the exclusion of all else, is to find out what central banks will do to back up their words on keeping yields low. The following comments from a note by Deutsche Bank currency strategist George Savalos put it well. Central banks are not impotent. This is not an attack on a currency peg with a self-fulfilling depletion of foreign currency reserves. Central bank pockets are literally infinitely deep in their own currency. The most straightforward response to today's price auction would be for the Reserve Bank of Australia to come in even more aggressively overnight to defend its 3-year target, which is exactly, of course, what happened. Similarly for the ECB, where we've already seen the 3 most influential executive board members expressing concern. Even for the Fed, it is worth remembering that guidance is couched in terms of current QE of at least $120 billion per month, providing inbuilt flexibility for an increase. The current volatility, unaccompanied by improving inflation expectations and directly challenging central banks' reaction functions, resembles a VAR shock for the market and risks leading to a broader tightening of financial conditions. How much it runs will ultimately be determined by how deep into their pockets central banks are willing to reach. We'll have to find out over the next few days. To illustrate Savalog's point, the RBA announced that it would buy $3 billion of bonds to keep the yield curve where they wanted it. That is what happened, of course, initially, but then it started to rebound, and then they had to come in and buy some more again. And that prompted this from Zero Hedge, entitled Australia's Yield Curve Control is on the verge of collapse. 3 weeks after Australia's central bank announced on the 1st of February an extension to its QE program by a further 100 billion Aussie dollars, when it also said it doesn't expect to increase interest rates until 2024 in pursuit of the central bank's yield curve control. Of course, Governor Philip Lowe has previously set the 3-year target at 0.1%. Overnight, the RBA purchased a whopping, for Australia, 3 billion Aussie dollars in 3-year government bonds in the secondary market on Thursday, triple the amount it bought on Monday, and the most since the bond market turbulence during the COVID-19 pandemic last March. And it's all in the name of preserving the RBA's credibility and keeping the 3-year yield around 0.1%. Unfortunately, it increasingly appears that the RBA's yield curve control is failing as the market is pressurising the central bank's commitment to the point of failure. When the RBA announced to the market at 11:15 a.m. on Thursday that it would purchase $3 billion of 3-year bonds, the yield on the April 2024 bonds declined slightly from 0.13 to 0.125%, but the yields soon after jumped as high as 0.14% before settling back to 0.13. Now, according to ANZ economist David Plank, the RBA has been unsuccessful in dampening bond yields at the short and long end of the curve, and the RBNZ's move has made the RBA's task even more difficult. There is upward pressure on market interest rates, and that will flow through into quite a bit more expensive borrowing rates for states and corporates for 10-year money compared to the start of the year. Now, of course, in Australia, mortgage rates are not priced off the long-term 10-year bond yield rate. Similar to his Fed peers, RBA Governor Philip Lowe has said he doesn't expect the cash rate to rise until at least 2024, but his guidance has been challenged by bond traders who are observing the scorching inflation everywhere, and they're convinced it is only a matter of time before Australia yields. The yield on the 3-year government bond remains stubbornly elevated at 0.13%. That's 3 basis points above the RBA's 0.1% target. But the biggest shock, according to Bill Bovington from Altus Asset Management, is that the market barely moved on what should have been a pretty positive surprise. I think they might need to intervene at the longer end with more QE, because otherwise they will have unhelpful spillover effects in the currency and start to impact on things like property trusts and broader contagion into equities. Australia's 10-year borrowing cost has jumped to 1.72%, a doubling of the yield since the RBA officially unveiled its QE program last November. ANZ's Planck says the rise in global long-term yields was a good news story about the success of fiscal and monetary policy stimulus, but there has been a lift in Aussie rates quite a bit higher than US yields, and that means that there will be more buying of Australian bonds and push up the Australian dollar. As a result, the market is confused about the RBA's messaging. The Australian 10-year yield has jumped 0.13 of a percentage point, or 31 basis points, above the equivalent US Treasury rate, higher than the gap of 0.16 of a percentage point, or 16 basis points, which Deputy Governor Guy Debelle began signalling last September that QE was coming. Then, soon after officially announcing an initial $100 billion QE program in November, the Australian long-term bond yield fell 0.07% of a percentage point, or 7 basis points below the US Treasury. A big reason for the lift higher in yields is surging commodity costs. Iron ore prices have surged to above $175 a tonne, the highest level in a decade, which has contributed to upward pressure on the local exchange rate. Meanwhile, with virtually all RBA ammo used, the Australian dollar is on the cusp of 80 cents US, despite renewed ultra-easy monetary policy commitments by all central banks. This is becoming a major headache for export-heavy Australia. And as it watches its policy have less and less impact, the RBA now owns $18.5 billion of the $33 billion April 2024 bond. The market is pricing in a jump in rates, with the yield on the November 2024 bond blowing out to 0.36 of a percentage point, or 36 basis points. A market participant quoted by the Financial Review said that there was not huge selling of local government bonds in recent days, but there was not a lot of buying. When there is less demand for bonds, bond prices fall and yields rise. Ultimately, there is just one solution. The RBA will have to step in and buy much more bonds, which is, incidentally, how the surge in US Treasury yields will also end, with the Fed capitulating and realising it will too have to join the rest of the world in at least trying to control the entire yield curve, and at that point, of course, capital markets will officially die. Well, that may be too grim a position, but certainly the tussle between the markets and central banks is on, and on big time. This may be just a short-term blip, or it may be something more structural. We'll know in a few weeks' time. But I have to underscore once again that all of this talk about inflation may well be overblown. And because I believe that deflation is more likely than inflation, maybe this will play out differently to the way that many people think. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.